What do you do when the inevitable terrible thing happens? How do you protect yourself and your financial plan when the bad things come calling? Whether that's a crisis, a health event, some other kind of catastrophe, what do we do to protect everything that we're trying to build? Hi, my name is Freeman Linde. I'm a certified financial planner and tax advisor, and I help folks retire successfully and stay successfully retired. And you're right in the middle of a series that we're doing on creating a financial plan. So if you are a DIYer and you are trying to create your own financial plan, then this series is for you, right? We're going step by step how to look at things, what to make sure that you include in that financial plan. And so if you haven't watched the first few episodes, make sure you go back and view those. But what we're talking about today is something that is important, and that is insurance planning. Right? How do we protect what we're trying to build with this financial plan? Right? So we can do all the great things in the world, and I come up and, if you were hiring me and I came up with a great investment plan and all this tax plan that was going to save you hundreds of thousands of dollars, and then something terrible happens and you lose it all because we weren't properly protected, then what was the point? Right? And so if we're trying to build all these things, we need to make sure that we protect it with the proper insurance. And real quick before you tune out, right, I am a fee-only fiduciary. I don't sell insurance. I don't make any commissions off it. There's no affiliate link in the description below, nothing like that. And so if you're like, oh, it's just another pitch for why we need insurance, no, it's really not, right? Which kind of brings us to our first point, right? When we're creating a financial plan and we're doing the investment or the insurance planning part of it, it's insurance planning, not insurance selling, right? If you go to an insurance salesperson, you for sure need insurance, right? They will definitely say, yep, you need this insurance and that, and you need to increase this coverage and upsell you here, there, and whatnot. And we're not doing that here, right? Insurance sales starts with the product, says, hey, we're going to force this into what you're trying to do, and we're going to get paid a big commission to do it. And we don't get paid unless we sell a product. We don't get paid unless that actually places. So again, if you are a hammer, everything looks like a nail. If you're an insurance agent, then everybody needs insurance. Insurance planning, on the other hand, it starts with your actual life and what you're trying to achieve, right? And then finds the right coverage at the right amount, and it might actually mean dropping coverage, not adding some. That is what we're talking about today. This is not an insurance pitch for you to get some. It's just making sure that we've thought through all the different insurance types and have a plan for each one. I'm going to fly through this one. We're going to try to keep this one shorter because it's not the most exciting topic, but it is important. Right? But again, one event can change everything. If we have this perfect plan and then the catastrophic thing happens, it doesn't really matter. Nothing else in the financial plan is going to replace it. So I have insurance. Again, I don't sell it, and we need to make sure that you have the right insurance as well. So 4 types of risks that insurance can cover, of course, are medical emergencies, disabilities, premature death, and property loss. And so if we have this medical emergency, this is a big one for people leading up to retirement, retirees, right? It can drain what we have. If we don't have the right coverage, it can drain all of our savings. If you've got a disability, right, you are supposed to be working for several more years, but then you can't work, you're still alive, the bills still come in, sometimes more bills, and you don't always have the income to cover it. Or that premature death, right? People who are depending on your income, and then you're gone, and you can't provide that anymore. What do they do? How do they cope with that loss when you're gone? And then, of course, property loss. Home, vehicle, all these things. It doesn't really matter, right? If we pay off the house, now we're no longer required to have homeowners. Let's just drop that. We pay this every year and won't do it. House burns down. Doesn't matter how many awesome Roth conversions we have planned if you're on the hook for a $500,000 house that was uninsured, right? Now, obviously, pretty much nobody doesn't have homeowner insurance, but the same thing is true about a lot of other things as well. And so let's look at the health one first, medical insurance, right? This is where you are going to want to make sure you have a plan for, and for a lot of people, it's kind of this factors into, I'm segmenting this up into different videos, but it's all connected, right? The health insurance planning that you do will be connected with your retirement planning, whether you're pre-retirement, post-retirement, that's going to play a role into what types of insurance you have. But while you're still working, you've got the high deductible health plan that can come with the HSA, right? Usually lower premiums, high deductible, you pay less per month, have more money to invest in other places. But when things come knocking, you have to pay more before the insurance kicks in. You got the HMO, lower costs, requires the referrals, PPO, a lot more flexible. You're going to pay that higher premium, but then you can go wherever you want. You don't always need referrals, right? So most of that, it's going to depend on where you work and the options that you have. It's July now is coming in, but we want to make sure that if you're still working, that we really look at this, because a lot of people just click auto renew on their current policy without really looking into, as we're creating a plan, should we be looking at other types of insurance? If we're not on a high deductible plan, does it make sense to move over to one so that we can max out an HSA, get that triple tax advantage for that account? It's the best accounts ever. As a real quick aside, right, if you're looking at, hey, what should I fund first? I would first fund any 401k where you're getting a match, so up to the match. So if you get a 3% match or a 5% match, I would do that. Number one, that's the first place I would put money. The next place I would put money is if you have a high deductible plan with an HSA. Number 2 would be your HSA plus invest it, right? This does not apply if you're just leaving it in cash inside your HSA. But if you can invest it, that's what I would do next, and I would do that before Roths, anything else, right? Because again, you get that triple tax benefit, tax-free going in, tax deferred growing in there, tax-free using it for health and care later. You're like, oh, I'm healthy, I won't need it. You'll need it eventually. Trust me, there's plenty of health costs down the road in retirement that you could do too. This is not a HSA video. I've got those. You can go watch those. But it's so good. You can't not say something about it. Okay, right? So if these are your main options while you're working, you would then look at, okay, if we are between working and Medicare, age 65, is there going to be a gap there? Are we trying to retire before 65? I was just meeting with someone today. Age gap, right? He'll hit 65 before she retires, both on her insurance, but she's still hoping to retire 60, 61. And so they'll have a 4 or 5 year gap there where we need to have a plan for insurance planning, right? What are we going to do there? Marketplace, right? You can either get it, life events would include retiring, loss of coverage. You can jump on there, order an open enrollment. I would say sometimes subsidized, depending on your, and so that's where a lot of it comes down to, this is where, right, not only does insurance planning connect with retirement planning, it also connects with tax planning, right? Are there ways where we could, hey, here's the limit for getting a subsidy on your health insurance. Your income's going to come in right here, so you're not going to be able to get it. Is there a way for, hey, the next few years, can we raise this, and so that over some other time you can actually drop down below it and just be just underneath that? And you can actually still be making this amount of taxable income, of modified adjusted gross income, or this amount of modified adjusted gross income. That's what qualifies for the premium tax credit. And you could still be living on this. This could be your take home, but your taxable income is here, your magi, which would then qualify you for a premium tax credit, save you several $1,000s a year. It's often $1,000+ a month that can save you. So if we can do that, and you're saving $15,000 a year for 1, 2, 3 years, that's a lot of money that you can save by doing good insurance and tax planning, not just winging it every year. And that's why some of this is very important. You may, again, you could dovetail that into COBRA, right, which is just continue your employer plan after you no longer work there. It's expensive because right now, right, the employer is paying half of it and the employee is paying the other chunk, right? And sometimes the employer is paying like 80% of it and you're only paying 20. Well, on COBRA, you still get the plan, but now you pay both. You pay both sides. And so that's where it gets really expensive. And a lot of people don't really realize how much their employer is paying for their health insurance until they need to. I think there's also like an 18-month limit on COBRA. But that could factor in. Maybe you're on COBRA first while you're qualifying for a premium tax credit, and then you jump on the premium tax credit. So there's different ways to plan this. Lots of iterations that you could do on that, but you want to make sure you have a plan for any of those gaps if you're planning to. And then can I get rid of this stuff? What's my oops. Well, whatever. Sorry for writing all of this. Medicare then, right, kicks in at 65. You got original Medicare, Part A and B. Medigap fills in the gaps in original Medicare, or you can switch over to Medicare Advantage or Part C, which is kind of switching from Medicare itself to a Medicare plan that's run by a different insurance company, right? It's a lot of the same coverages, just run by another company. there's pros and cons to all these things. I've got a whole workshop on Medicare that you could go find, and I'll do more in the future here too. So lots you could say on all these things, but medical insurance planning, big part of retirement planning in general, financial planning in general. You want to make sure you have a plan for that. Disability income, right? If you can't work anymore, but you still need the income, great. And a lot of people say, well, I've got group insurance. Okay, well, usually it's only a fraction, right? 60% maybe. A lot of times that's capped. So if you're a high income earner, just know a lot of times your group stuff is capped. Just so you know. So you remember something in your mind, it says 60% or 66%, but you didn't realize that there was a cap on that, and so you're actually only getting like 40% of it replaced. So that's where you might do an individual policy to fill that gap, right? I've got group, like I run this company, we have group disability here, we have that, mine does get capped. I also have an individual policy that I pay for. I did not sell that to myself. Again, I haven't been insurance licensed for years. I paid full price, just like all of you would have to. Right? If you are close enough to retirement, you probably don't need this, right? If you're 2 to 3 years out, for sure, you're probably not going to need it. 5 years out, maybe, probably not. If you're 10 years out or earlier, though, you're almost certainly going to want this. I would say if you had to choose between disability, if you're younger and watching this for some reason, if you're in your 40s, you got kids, all this stuff, if you got minor kids, and you had to choose between disability and term, I'd probably choose disability as the one to get. Super important. Get it if you have people depending on you for your income. And check what you actually have. A lot of people just wing this one. They think they know what they have and they don't know it all. Term life insurance, right? If you've got, and I always like to say this, right? Life insurance is for protecting your family, not for building wealth. Again, I have whole episodes on this. Just get term. Permanent life insurance is super oversold. Kind of sucks. Really sucks usually. So yes, I am a buy the term, invest the difference. Yeah, there's a whole bunch of retorts to that. I've got whole episodes on that. So go find that. If you've been sold permanent life insurance or someone's trying to sell permanent life insurance, go find my videos on that. But right, if you've got people depending on you and your income, you probably need term. A lot of my clients getting close to retirement, right? In retirement, some of them still have it, and like, do I still need this? I still have a mortgage, so I still want it. I was talking to a client the other day, and she's got $2 million, retiring in September. Her group life is then expiring, and she's wondering if she still needs some because she's still got a mortgage, but she's not spending enough of her money. I'm always getting on her to spend her money, and she's like, well, should I go get some other coverage or continue this coverage because I still have my mortgage? I'm like, well, what happens if you die without it? Your kids are just going to sell your house and then the mortgage will get paid off then. And if that doesn't work, they can just cash out one of these brokerage accounts and pay it off with that. Like, there's plenty of money here. We don't need it for that. And so she's like, oh yeah, I guess I don't need that. So if you don't actually need it, don't use it, right? And if you have people depending on you, make sure you get it. I've got big term policy on me. So again, I have it, I pay for it, and don't pay for it if you don't need it. Okay, home, auto, umbrella, right? Homeowners, what we want to make sure is that it's one thing you should check on yours. Here's some homework if you got it. Make sure that it would actually cover the full rebuild cost, right? Cost to replace. Sometimes like you think your house is worth $400,000, and so you've got $400,000 of coverage. But if it actually burnt to the ground and needed to be rebuilt, it would cost way more than $400,000 to do that. Because now you're talking all new materials. Like, your used house is worth $400,000. To build the same layout in new materials would cost way more than that. So make sure you have full replacement value on your coverage. For homeowners, that's important. Auto, right? You don't want just the state minimums. Make sure you have better coverage than that. I think state minimums in a lot of states are still, $100,000 per person, $300,000 max per incident, and it's been that way for decades, without any, I don't know how long it's been, but a long time, without any inflation. So you'd want at least $250,000, $500,000, which then in most things also allows you to get a nice umbrella policy. Look at this umbrella. Isn't that great? Which is just more liability on top of it. Because again, it doesn't matter how great of a great Roth conversion strategy, tax plan, whatever else we have for you, if your phone buzzes, you look down for a moment to check it, you look up T-bone and minivan full of people. and you're on the hook for it. And like that's going to do more than $300,000 of damage, probably more than 500. So this plus, $1 million umbrella is probably a pretty good place to start. Umbrellas are not expensive, so do that. And then I would pretty much always go independent. In some states, the captive people like American Family, farmers, that kind of stuff, sometimes they can be pretty competitive, and a lot of times they're just really expensive, and you can save a lot by switching. So double check it at least. So again, right? We want to cut out any waste. If we're overspending insurance, I want you to not do that. If you don't need insurance anymore, life insurance, whatever else, I want you to get rid of it. But we do want to plan, right? So eliminate any unnecessary coverage, because every premium dollar that we're spending on investments is something that we can't spend somewhere else, right? And so a lot of times you've got overlapping policies or whatever else, and we can just redirect that somewhere else. Sometimes we're saying, well, hey, I don't know if I want to pay, $8,000 to get to my deductible. It's like, you've been healthy every single year for decades. You never get anywhere close to this. So get the high deductible plan and put that money away. And if you look at both what you're saving in premiums plus what you're saving in taxes by maxing out the HSA, then you end up way better off than continuing to do your HMO plan that you're doing right now, right? So eliminate any unnecessary coverage that we don't need. The other one that we just want to touch on briefly is long-term care. Obviously, that can be very expensive, $10,000, $12,000, $15,000, $20,000 a month. And so what I would say, right, is we want a plan, not necessarily a product, to deal with that. All right, we need a plan for long-term care, not necessarily a product. Generally, I don't recommend long-term care insurance. I just mention it here because people associate it with insurances, but you for sure need a plan as part of your overall financial plan for what will we do, how would we pay for this if we need to spend $12,000 a month on nursing homes. Where's that coming from, right? And that's where if you have 3D retirement income, ta-da! Let's see, here we go. Whoop. I don't know where that went, why that's doing that. My book has some, it's creating a retirement income that keeps growing, outlasts you, whatever else. And so it's a great way of self-funding some of those expenses. So, and I will say this, right? You want the proper coverage first. I'm more concerned that you have the right coverage and then that you save money. Right? Some people go the other way. They're trying to save the most amount of money first, and they don't care about getting the proper coverage. They get state minimums. They don't get replacement value on their home. They're doing this, that, or the other thing. Make sure you're covered first, then look for savings. Right? So get the right coverage, then reduce costs. Shop whatever else you need to do. Perfect. And then any savings you have, right, you can obviously redirect those towards other goals. So you want to build a plan, right, that can actually survive real life, because we have all these fancy charts and graphs and everything looks great, and then real life happens. Murphy's Law, if it can go wrong, it will go wrong. And so the goal is not to buy more insurance, right? The goal is to build a financial plan that can survive real life. Once you plan it, protect it. And so we want to make sure we're doing the right insurance plan. Kind of stuck this in the middle. Doesn't really matter when you do this, but some of this, especially the health insurance stuff, would build into the other things. So before we get into the pre and post-retirement planning stages of building a financial plan, I wanted to make sure we covered this. So speaking of which, right, if you are pre-retirement or already retired, either way you need a plan. And so we will cover both retirement planning as a main topic, but we will cover that in two separate pre and post-retirement planning segments. So subscribe if you haven't already so that you can get those videos when they come out, and we'll see you next week. Cheers.